You're listening to the Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? It's Mike from the Moose and the Loose. I hope you are doing well. Yesterday, we discussed safe stocks in this volatile market. Today, we're going to talk about stocks that went down more than 10% since the beginning of the year. And we're going to discuss if they are great opportunities or not. We have 8 on the list. And it's kind of interesting because we do have kind of like a lot of uncertainties, but the Canadian market so far did not do that bad. So finding companies going down by more than 10% over the past like 3-4 months wasn't that easy actually to find quality stocks. I mean, bad stocks going down 10%. I mean, they are legends. But when you're looking for companies with a good business model, that's something different. So we're going to end this podcast with my favorite 2, but we're going to start with one that lost even more than any other stock on the stock market these days, and I've discussed this at length, actually deserved one full episode last week. TFI International. So this one, they reported bad earnings. The CEO was like super transparent saying, you know what, we're down, EPS down by like 30%, and it's going to be the case for the rest of the year. So TFI International plummeted by more than 40% from the top of my head. So definitely this one took a big beating. However, when you look at the overall business model, yes, it's going to be a disgusting year for them. So you'll have to be patient, especially if you enter right now. Maybe we're at the bottom, maybe not. That's always the problem when you're trying to catch a falling knife, is maybe TFI is going to drop by another 20% until it reaches a plateau and then eventually recover. But it has a lot of potential. So this is what it's interesting about this one, is the fact that the business is not doing that bad right now. They're still profitable. They still have a lot of volume. They still benefit from their economic moats, wide network, economies of scale, ability to make more acquisition right now in this crazy time. So maybe it's just going to be one of those pivot years for a great company, and they're going to be able to turn that around. So that could be interesting to follow. Another one that I would qualify high risk, high reward type of investment is ADEN.TO Power. They're making dry type transformers, electric transformers, not toys. And most of their business right now is done in the US. They got incredibly popular because for the quality of their transformers. They're like making like super high quality ones. They've been around in this industry for ages. And the fact that they provide high quality products to data centers to compute a lot of artificial intelligence could be incredibly interesting for them. Lots of growth potential, and the stock price skyrocketed for a while and then plummeted. I've made a lot of warnings on this one because it is an exciting company to follow. The problem with this type of business is it's a small cap. It is highly tied right now to the US. So with the commercial tension, it's not going to be the greatest place to be. And then also most of its growth right now is all focused on data center, and that could be another problem depending if we need massive investment or not. In this sector, it's unclear if we are able to benefit from artificial intelligence elsewhere. So just be careful about this one. So for the reference, TFI International is TFII, the ticker, ADEN.TO Power, HPS.A.TO. Now moving on to Capital Power, CPX. This one is a roller coaster. It's not the first time. I mean, it goes up, it goes down very quickly. I'm not too sure why, because most utility companies are a lot more stable in their stock price. This one, they have like either a terrible year or an incredible one. So last year, they were up like 70%. But part of it was because they were down in 23. So in 24 was great, and in 25 not so great. One of the thing is they are trying to make that transition into providing power to data center and anything that is related to AI. So again, an interesting play, but for that reason, the stock is more volatile than other utilities. But I was quite surprised to see this one drop like a rock in 2025. A company that I rarely talk about, Cameco. Cameco produces uranium. So I know, again, my dislike for commodity related business models. So this one, again, if uranium price goes up, it's going to make a killing because they are a rare European uranium mining company in a stable country. So offers an important mineral for nuclear power for sure. And right now there are a lot more investment in those nuclear power plants. A lot of them are in construction. They will likely need Cameco's products. So they are in a good place, but they're highly linked to whatever happens with the uranium price. So that's probably explain when the stock price goes up or goes down, it's going to be linked to that. It is paying a very, very small yield as well, not always increasing it, I mean, for obvious reasons. So just be careful with this one if you are interested. But if you want to make it play on nuclear energy and you don't want to go for utilities, this could be an interesting one to add to your list. We have 4 more stocks now to discuss, including my 2 favorite ones at the end of this episode. So yes, I'm gonna keep you waiting until the end. In the meantime, ADEN.TO, ADEN, interesting company in the wood distribution business. They're making a lot of like lumber for commercial usage, which is interesting. Is they have a large exposure to the US, but they also make most of their products in the US. The CEO in the latest earnings said 90% of her business is not affected by tariffs at this point. So that could be interesting along the way. Again, highly volatile, but they grow by acquisition. They have a good exposure to the US. So yes, it's not a good time to invest. I mean, it's actually a good time to invest in a recession. You just have to be patient because they're going to make money if construction goes up. Right now, I don't necessarily expect that the construction industry is going to do incredibly well in 2025, right? Jameson Wellness. This one, a lot of love and hate relationship with this one. I really like the stock. I really like the company, actually. But the stock doesn't generate much return. I don't have it in my portfolio, but I just want to highlight that this one is interesting. The company is a leader in vitamins and supplements. And they're selling in Canada, they're selling in the US, and they're selling internationally. They have spent a lot of money to expand internationally. The revenue keeps on growing on a very steady basis, but the problem is earnings. It goes up, it goes down. Like the major investment in marketing and adding sales representative, it hurts the margin and of course the earnings. So while the revenues are going up steadily, the earnings not so much. So that's probably why. And the fact it's a small capitalization, not always easy to navigate in a volatile market with those smaller companies. So more volatile, of course. But anyways, JWEL, Jameson Wellness, could be interesting to have on your list. Now, moving on to my favorite 2, actually, Canadian Natural Resources, CNQ. Obvious choice. I mean, whenever we fear that the economy is going to fall into a recession and the market goes down, well, another thing goes down very quickly, and it's the oil barrel. I mean, it's like obvious playbook. Whenever it happens, the oil industry is getting hurt, of course, because if the economy is slowing down, everything depends on oil on one side or the other. So the demand will also decrease. So CNQ will continue to generate amazing amount of cash flow, and still their stock price is going down. So that sounds like an obvious deal for me. I already have it in my portfolio, so that's full disclaimer. I'm not telling you to buy. That's not a buy advice, but just maybe look into very solid, reliable energy companies. So not those like pump and dump type of stuff that goes up, goes down, and you have to be incredibly lucky to buy it at the bottom, then sell it at the top to cash your profit. CNQ is a lot more stable than that. I don't see it as a super powered company where it's going to grow like 5-10% every year, though. I see it more like a deluxe bond where it pays a very good yield and the dividend keeps on increasing. The company's buying back shares, they're increasing their dividend, and from time to time they're making acquisitions. So that could be interesting moving forward. Finally, I'm going to end up with my favorite one, National Bank. Yes, my friend. I mean, of course, one of my top holdings. The company was trading above $130 not too long ago. Now is trading around like 110 or something like that. Yeah, 113. So yeah, that was quite a drop. The company completed the acquisition of Canadian Western Bank. The company keeps on doing well, but two things that bugs me right now that probably explains why the stock price is not doing that great. The first one is they reported higher provision for credit losses in their latest earnings. So even though wealth management and capital markets did well, the personal and commercial side, yeah, that was not good. Definitely not. And the other thing is with tariff war, I mean, they do have ABA Bank in Cambodia. So if Cambodia could get hurt if the tariffs remains in place and hit their economy, well, of course, defaults on loans where National Bank is going to take a hit there. That could be also a bad news for them for the short term. So it's going to be interesting to see what they have to say about their next earnings call about ABA Bank and how it's going. So far, just look at the provision for credit losses. It's going to tell you a lot about that. So, right, Moose, a little bit longer episode today, but I hope that it was fun. Don't forget to, if you have time, if I'm providing value, just go on Spotify or Apple Podcasts. Just give me that 5-star rating for the Moose on the Loose. That's the only way I can grow this podcast. So I need your help. I'm counting on you. And if you're having fun listening to me every single day, well, just take 15 minutes of your time to thank me back. All right, guys, we're going to talk tomorrow about if you should deplete your RSP faster or not. That is a big question. We're going to see. I mean, the answer is it depends, but we're going to see what it depends on to help you, giving you a framework to make the right decision for you. All right, guys, take good care. We're going to talk again tomorrow, and don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to the Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.